Hello, my name is Brenton Harrison, and we're here today to talk about credit utilization, what it is, and how it actually impacts your credit score. Let's get started. Establishing and maintaining good credit is really one of those foundational items that you have to have when it comes to building out a well-rounded financial portfolio. And even if you're the type of person who's debt averse, the habits that it takes to build credit, like not borrowing more than you can pay back or paying things on time, these are things that are helpful even if you are not focusing solely on your credit score. And while there are a bunch of different scoring models out there, there's Vantage scores, there's FICO score 8, FICO score 10, so on and so forth. The FICO scoring model itself is still the most widely used of those in the financial sphere. So if you're going to improve your FICO score, you first need to know the ins and outs of the scoring model itself and how the different activities that you have from a financial or monthly perspective are reported to the bureaus that compile those scores. We've done videos in the past about the different components of a FICO score, and it's really important that you understand those. But if you have a deeper knowledge and understand when and how the activities that you do on a monthly basis are reported to the credit bureaus, you can use that knowledge to time and structure your transactions so that it benefits your score as much as it can. But first, let's review those components of a FICO credit score. At 35%, you have your payment history. This is the largest component of your credit score for all the tricks and tools, including some of the ones that you see in this video about how to increase your score quickly. The best way to build and maintain strong credit, the first principle is to simply pay your bills on time. The second component, which we're actually here to discuss today, is credit utilization. We're going to talk about what that means in a second, but credit utilization is the second largest component of your credit score for a FICO score at 30%. Next, we have the age of your accounts. This is 15% of your score, and age of accounts is essentially how old is your credit. Every time you open a line of credit, it's given a birthday. So if you open an account today, it would be X year 2021. And as that credit ages, it looks better and better on your score. Now, we've talked in the past, and people might have heard about, oh, if I close a credit card, I should just cut it up and close the account. There are things like that that you actually don't want to do, because if you close a line of credit, no matter how poorly you might have managed it in the past, you are now wiping that birthday off of the age of your accounts and lowering the average age of your credit. It would be better if you just stopped using the card once it's paid off instead of canceling it, because the older the age of your credit, the better it will reflect on your credit score. Next, we have credit inquiries. This is 10% of your score. It's a smaller amount, but still something you want to pay attention to. Essentially, you don't want people checking your credit if there's not a need to. The more people that make inquiries into your credit or hard pulls of your credit, the worse it reflects on your score. And lastly, we have your credit mix. This is essentially an assessment of how diverse your credit is. Do you only have credit cards? Do you only have student loans? Do you only have a mortgage? You don't want to take out credit just for the sake of diversifying your score, because this is such a small component, but the more diverse your credit, the better it reflects on this category. Now let's focus on credit utilization, because in my opinion, this is the most misunderstood element of what makes up a FICO score, both by those who are really great with their finances and by those who are struggling to build good habits. Both sides of the fence often struggle to understand how credit utilization actually works. Credit utilization is a ratio that's used to show the amount of your available revolving credit that you've borrowed at a particular point in time. Revolving credit is a type of debt that technically has no payoff date or end date. So an example would be like a credit card or a line of credit, where you have a certain amount of money available to you that you can borrow, but the determination of how much you pay or when you pay it off is largely up to you. If you want to pay the minimum amount on credit card debt, you could technically have that debt for the rest of your life. Another example of a different form of debt would be installment debt. Installment debt would be something like a student loan or a mortgage, where you borrow an amount of money, but the terms of repayment are set in advance and there is a definitive payoff date for that installment. So credit utilization does not factor in installment debt. It is only an assessment of how much of your available revolving debt you have borrowed at a particular point in time. If, for example, you have a couple of credit cards that have a $10,000 limit, the amount that you've borrowed on those cards at the time the credit card company sends a report to the credit bureau is what will be used to calculate your credit utilization. And if I could underline that, I would. The amount you've borrowed at the time the credit card company sends a report to the credit bureau is what's used for this calculation. In terms of what constitutes a strong credit utilization ratio, there's a rule of thumb called the 30% rule. And this rule is something that's become popularized because the concept is that as long as you keep your utilization ratio below 30% of your available revolving debt, then it won't have a negative impact on your credit score. So in our $10,000 example, as long as you keep your utilization ratio below 30% or $3,000 worth of charges, it wouldn't have a negative impact on your FICO score. And while this might be true, I think that this rule is bandied about a little too much because in actuality, the lower your credit utilization ratio, the better, even further below that 30% benchmark. And as an example, if you look at a number of studies that have measured and analyzed people who have perfect credit scores, many of the people, I should say the majority of the people in those studies have a credit utilization ratio below 10%. So even though 30% is the rule of thumb, the lower you can get that utilization ratio, the better it will be for your credit. Yes, and yes. We mentioned that there are many different types of credit scores within those two major camps of FICO and Vantage Score. And all of those scoring models are going to have different idiosyncrasies about how they view your utilization ratio. But a good rule of thumb is to assume that they're going to assess not just the individual card or the individual line of credit, but also the utilization ratio for your total revolving credit. If you had, in our example, that $10,000 of available credit at your disposal across one or two or three or four cards, and you had $3,000 of reported balances across those cards, you would have a total credit utilization ratio of 30%. The biggest breakdown in understanding as it relates to credit utilization ratio is people not knowing how and when their credit card balances are reported to the bureaus who compile their score. For credit cards in particular, there is a huge difference between the amount of balances that are actually reported on your statement balance and the amount that you still owe by the time the payment is due. Let's do a quick breakdown of some of the key terms related to credit card payments and then tell you what's reported to the bureaus and when it's reported. First, we have statement period. And the statement period is the length of time in which the charges you make will be reported. As an example, if you have a credit card statement period from January 15th to February 14th, the only things that will show up on your bill are the charges that you made within that period of time. This is your statement period. Some cards will call it the statement cycle. Next, we have your statement balance. And the statement balance is the amount of money that you still owe on that credit card by the end of the statement period. And I say still owe because you might have made payments throughout the previous 30 days. If the statement is from January 15th to February 14th, and in that period of time, you charged $1,000, but you paid off $500 in that same period of time, your statement balance would show that you still owe the remaining $500. Next, we have your payment date. The payment date is the date by which you must pay off the full balance on your statement to avoid having interest added to those charges. It's typically a few weeks after the end of the statement period. So if you have a statement period from January 15th to February 14th, at the end of that statement period, you're going to get your statement balance. And you'll have a couple weeks or a few weeks after that to pay those charges off and avoid interest being added. So maybe if it ended February 14th, you might have to pay off that statement balance in full by March 10th to avoid having interest paid. Lastly, we have credit limit, and your credit limit is the maximum amount of available credit on that particular card. Let's use some of those variables we just discussed for a broader example so that we can understand how this person's credit utilization will be reported to the credit bureaus. We're going to have in this example a statement period of January 15th to February 14th. And during this period of time, the person that we're monitoring made $1,000 worth of charges out of their $2,000 credit limit. So at one point in time, they've borrowed up to 50% of their credit limit. But as long as they pay it off in full by March 10th, there will be no interest that will be assessed to any of these charges. And we're going to assume that they do pay this off in full by March 10th. So even though they racked up $1,000 worth of charges, they paid it off in full by the payment date. So they did not owe any interest on these charges. So using these numbers, it would seem like this person has a really good credit utilization ratio. After all, they didn't pay any interest, so they should be just fine because nothing carried over to the next month. But what would their utilization ratio actually be? Like I said, you would probably think it would be pretty good and they'd be in good standing, but you need to understand the date that this balance is going to be reported. Because for many credit card companies, the account balance they report is the amount that's listed at the close of your most recent statement period. That's right, they don't report at the payment date, they report the amount you borrowed on your statement balance. What this means is that even if they charge, every charge they make during a statement cycle is paid in full before the payment date, you can still have a poor utilization ratio if you have a high balance at the close of your statement period. And you can see that in this diagram. The start date was January 15th. You can see the statement cycle. You can see February 14th is the end date, but unfortunately, that is the date that they report the balance. So even though there was no interest on these charges because it was paid off by the 10th, this person would have a 50% credit utilization ratio, which is way too high to maintain a strong score, at least in this element of the FICO. Now, let's say that this person who is paying their credit card off in full, by all intents and purposes, they're doing a great job financially, had this type of activity the month before they tried to apply for a home loan. But when they run their credit, they're going to have a 50% credit utilization ratio, and it could really damage their score. Why? Because they paid their payment off in full by the payment date, but on the statement balance, it shows high utilization ratio. If instead they had chosen to pay that $1,000 off the day before the statement period closed, then even though they had charged $1,000 throughout the statement, they would have a 0% credit utilization ratio because at the end of that statement, you would have a $0 balance. They paid it off before the balance was reported to the credit bureaus. It's small tips like this that can make a huge difference when you're applying for credit for things like a home loan or a car loan or even a private student loan. And you want to make sure you have that understanding so you can use it to your best intent. As an example, I have credit cards. I use credit cards thoroughly. I'm not one of those who believes that they should never be used, but I never wait until my payment date to pay it off because I want to make sure my credit bill, my credit score is high at all times. So I actually set a calendar reminder so that I can pay off my credit bills the day before the statement balance closes so that I can always keep my utilization ratio at 0%. This is how credit utilization actually impacts your credit score. My name is Brenton Harrison, and I hope this video was useful to you. If you enjoy the videos we've been posting, please subscribe to our channel and subscribe to the notifications so that you know when new content is posted, and we'll keep bringing it to you as often as we can. Have a good one.